Hey everyone, welcome back to Corporate Decoder, the place where we expose the hidden secrets of corporate financial filings. Today we are diving deep into Okmin Resources, Incorporated's latest annual report. And let me tell you, it is a wild ride through the oil and gas game with some interesting financial twists and turns. Stick around because we're about to decode it all. And hey, if you love getting the real scoop on companies without the fluff, make sure you are subscribed. Also, we have a fantastic community over on Discord, linked right down in the description where we break down these filings in real time. Alright, we are looking at Okmin Resources Incorporated's annual report, specifically for the fiscal year ended the 30th of June 2025. This report is essentially their year in review, detailing their financial health, business strategy, and a whole lot of the risks they face. First off, let S touch on how their stock is doing. Their common stock is traded on the OTCQB tier of OTC markets under the symbol Okmin. Now, the trading volume has been pretty limited, meaning it is harder for investors to buy or sell shares quickly without affecting the price. You can see the high and low trading prices for their stock throughout the year. For the quarter ended the 30th of June 2025, the high was 6 cents and the low was also 6 cents. It was similar for the previous quarters in 2024 and late 2023, with prices hovering around those low single-digit cents. They had about 78 shareholders as of the 30th of June 2025. Now let us get into the juicy part, management's discussion and analysis of their financial condition and operations. This is where they tried to explain what happened over the year and what they expect in the future. For the fiscal year ended the 30th of June 2025, Okmin generated $22,180 in revenue from oil and gas sales. That might sound like a small number, and compared to last year, it is revenues dropped from $42,543 in the previous year. The company says this decrease is due to lower oil and gas prices and also because they had to cut back on operations due to limited cash. Their cost of revenues also went down, which makes sense if they are operating less. It went from $92,024 to $42,713. General and administrative expenses, which are basically the costs of running the business like salaries and office rent, were $388,579 for the year ended the 30th of June 2025. This is a bit lower than the $406,175 in the prior year. A significant chunk of these expenses were not paid in cash but were issued as stock, which is a common practice for companies to conserve cash. Now, the bottom line, the net loss for the year ended the 30th of June 2025 was $597,167. This is an improvement from the $873,214 loss in the previous year. However, it is important to note that this figure includes a one-time impairment charge of $167,003. An impairment charge means they had to reduce the value of their oil and gas properties because they are not worth as much as they thought. Without that charge, their operating expenses would have been lower. Let's talk about their cash situation, their liquidity and capital resources. As of the 30th of June 2025, they had total assets of about $133,322, with most of that being cash and oil and gas properties. But their total liabilities were much higher at $753,927, which includes things like convertible debt and deferred compensation. They had a working capital deficit of approximately $742,439. This means they owe more in the short term than they have in liquid assets. This is a significant concern. They only had about $11,488 in cash at the end of June 2025. Their continued operations and any future development will heavily rely on securing more financing. They acknowledge this need, stating they anticipate cash needs of about $270,000 for the upcoming fiscal year, which does not even include funding for potential workovers or recompletions. And here is a major red flag. Their auditors have issued a going concern opinion. This means the auditors have serious doubts about whether the company can continue to operate for at least the next year. It is based on their history of losses, their accumulated deficit, and their negative working capital. This is the most important signal for investors that the company's future is uncertain. Let's look more closely at their balance sheet for the 30th of June 2025. Their cash and cash equivalents were $11,488, a big drop from $72,281 the year before. Their oil and gas properties also saw a reduction. Their total assets are only $133,322, while their liabilities are over $753,000. That is a lot of debt. Looking at their income statement for the year ended the 30th of June 2025, their gross profit was actually a loss of over $20,000. Their total operating expenses were over $561,000, leading to a loss from operations of almost $581,000. While the net loss improved compared to last year, it is still a substantial loss for the company. When we examine their cash flows, it clearly shows they are burning through cash. For the year ended the 30th of June 2025, they used about $36,793 in operating activities. They also paid down some debt in financing activities. The net change in cash was a decrease of over $60,000. And remember, they started with very little cash to begin with. Now, for the notes to the financial statements, this is where the finer details are. Okmin Resources Inc. was incorporated in Nevada in December 2020 to focus on acquiring, exploring, and developing oil and gas properties. They focus on rework and recompletion opportunities with lower entry costs. With initial projects in Oklahoma and Kansas, they have 2 wholly owned subsidiaries. They have interest in 3 projects: the Vit Oil Lease in Kansas, the West Shepherd Pool Natural Gas Project in Oklahoma, and the Pushmataha Natural Gas Project in Oklahoma. Importantly, they mentioned that subsequent to the 30th of June 2025, they disposed of their interest in the BlackRock JV and gained a larger stake in the Pushmataha project. They also state they have not conducted any reserve evaluations and currently have no proven reserves. This is a key point. They are exploring, not producing proven reserves yet. They use the full cost method of accounting for their exploration and development activities. This means costs of both successful and unsuccessful exploration are added to the value of their properties. They also mention they are not the operator of any of their properties, meaning they have limited control over what happens. This section details their oil and gas properties. The BlackRock joint venture, for which they sold their interest in August 2025, generated revenue of $20,294 in fiscal 2025. The Vit lease in Kansas has 11 oil and gas wells and 4 injection wells. It generated a very small amount of oil revenue, just $354 in fiscal 2025. The West Shepherd Pool field saw suspended gas sales due to pipeline issues and equipment failure. The Pushmataha County project in Oklahoma had some gas production, bringing in $1,532 in revenue in fiscal 2025. They mentioned plans to rework and recomplete wells, but have deferred this due to current natural gas prices and a need for more capital. A crucial detail here is that there are no proven reserves on any of these projects. Under their stockholders' equity, they have preferred stock and common stock. The series of preferred stock, all owned by Jonathan Herzog, their CEO gives him significant voting control with 10 votes. Per S-Hair, this means he effectively controls about 46% of the voting power. Common stock has a par value of $0.0001 per S-Hair. At the 30th of June 2025, they had over 117 million shares of common stock issued and outstanding. They also issued a lot of shares for services, not cash, to consultants and lawyers. For the year ended the 30th of June 2025, their basic loss per common share was 1 cent. Diluted loss per common share was essentially 0. This reflects the overall net loss on a per S-Hair basis. This section details their dealings with insiders. Jonathan Herzog, their CEO, is being compensated with a significant portion of his salary accrued and deferred. As of the 30th of June 2025, the company owed him $438,750 in accrued compensation. This is a substantial amount for a company with such limited cash. They have a convertible loan that was secured by a lien on the Vit lease. As of the 30th of June 2025, the loan had an outstanding balance of $131,135 plus $63,956 in interest. Later in September 2025, the lender agreed to convert the entire balance into common shares. They issued over 6.5 million shares to settle this loan. After the 30th of June 2025, they made some key moves. They exchanged their interest in the BlackRock JV for more stake in Pushmataha, increasing their ownership to 95%. They also issued more shares for services and for legal fees. Most notably, they sold 1 million common shares in a private placement for $30,000, which they say will be used for working capital. This is the auditor's report. They state the financial statements present fairly the company's position, but again, they highlight the substantial doubt about the company's ability to continue as a going concern due to accumulated deficit and working capital deficit. Alright, let's shift gears and give you our take on Okmin Resources Incorporated. This company is in a very speculative and capital-intensive industry, oil and gas exploration. Their strategy seems to be acquiring existing leases and trying to rework them for marginal gains, with ambitions to grow through further acquisitions. The biggest story here is their precarious financial situation. With very little cash on hand, significant liabilities, and an ongoing net loss, the going concern opinion from their auditors is impossible to ignore. It signals a very high risk for investors. While they have improved their net loss from the previous year, it is still a substantial deficit. The fact that they are relying heavily on issuing stock, often for services rather than cash, leads to significant dilution for existing shareholders. This also means they might be struggling to attract traditional debt financing. Their reliance on operators for their properties also limits their control, and with no proven reserves, their exploration efforts are essentially a gamble. The small revenues generated particularly from projects like the VIT lease barely cover operational costs, let alone new investments. The decision to dispose of the BlackRock JV and increase their stake in Pushmataha might be a strategic move to consolidate resources or bet on a higher potential project, but it comes with increased financial obligations. In essence, Okmin Resources is a company operating on a shoestring budget in a high-risk industry. Their ability to survive and grow hinges entirely on their capacity to secure substantial new funding, which, given their current financial state and the auditor's warning, will be a significant challenge. The future looks highly uncertain for them. What is your take on these numbers and what they signal for Okmin Resources' future? Drop your thoughts in the comments below. If you found this analysis valuable, don't forget to hit that like button and subscribe for more deep dives into corporate finances. Also, check out the Discord in the description for more real-time discussions and analysis. Thanks for watching, and we'll see you next time on Corporate Decoder.